Let's talk about 5 myths that I hear every single day in the mortgage industry, and I'm even going to throw in a bonus. I'm going to call them out all one by one, so let's get started. The first one is FHA is a first time homebuyer loan only. Kind of, it can be good for first time homebuyers, but clearly FHA stands for First Time Homebuyers Association? Assistance. Nope, definitely appreciation. Nope, try again. Third time is not the charm. It just stands for Federal Housing Administration. It's really just a set of guidelines that they have set forth to help people get approved for loans and to help affordability for people who are looking for lower down payments and may have lower credit scores. You don't have to be a first time homebuyer to use it. Everyone can qualify for an FHA loan. The real restriction comes in when sometimes you just can't have two of them at the same time because they're only for your primary home. But FHA really stands out when you're looking at a minimum down payment and you don't have an 800 credit score. Number two, mortgage insurance, PMI, is the worst thing ever, and you should always put 20% down. Listen, no one likes PMI, but truthfully, it is not the villain everyone thinks it is. If you put less than 20% down, yes, you are going to pay a little bit extra per month in PMI. But just look at the numbers. On a $400,000 home with an FHA loan, you're going to be paying about $183 per month. On a conventional loan, depending on your credit score, it's going to change. It could be anywhere from $50 upwards to $200 to $250 a month with that same minimum down payment as FHA. But here's the deal. If you're purchasing that same $400,000 home, you are gaining access to the equity appreciation of that home. If you look back the last 100 years of U.S. real estate, dips and the growth, we've seen values increase about 3.5% per year, which means, yes, paying upwards of $2,300 to $2,400 extra per year in a monthly payment, but you're going to be gaining access to that appreciation of over $14,000 a year on that $400,000 home. Would you make that trade? I know I would, and I'm even doing it myself on my own home. Number three, my lender said that they're going to give me a free refinance when rates drop. Nothing is free in life, especially lending. Your free refinance is still going to include underwriting and lender fees. It's still going to include title fees and even an appraisal in the future too. What they really mean is they're going to give you a higher interest rate to get lender credits, and they're going to use those lender credits to pay for all those costs so that you have nothing out of pocket is one way. The second way with a no cost refinance is they just roll in all those costs into the loan so your loan amount goes up instead. So no matter what, you are paying for your refinance in some way. Number four, the seller is paying my closing costs on my home purchase. Nope, you are. Yes, seller concessions can be an amazing thing and they can reduce your cash to close dramatically. So I'm not saying here that seller concessions are a bad thing. It's just you rolling those costs into your loan, so you are paying for those costs. Let's take an example of a $400,000 home. You could offer $380,000 and the seller nets $380,000. You could offer $400,000 with $20,000 in seller concessions. You get the $20,000 to go towards your closing costs, and the seller still nets $380,000. Same deal. You're just financing the costs into your loan. Number five, this one comes from all you realtors out there. Closing costs should only be about $4,000 to $5,000. If you're paying more than that, they're ripping you off. Well, maybe if you're paying cash for a home, yes, your closing costs can be $4,000 to $5,000. But if you're getting a loan like most people out there, you are going to be paying extra in taxes and insurance up front for the lender. You're going to be paying an underwriting fee as well, and you may even pay for your own title insurance. So in most markets, that means that your closing costs could be $10,000 to $20,000 very, very quickly with all those taxes and insurance that you're paying up front. But spoiler alert, every single lender charges the exact same for taxes and insurance for you because it's your cost. If we charge you more, we can risk losing our license. We just get to be the nice people that get to tell you about it. And last one, here's your bonus. Rates are too high right now. I'm just going to wait and I'm going to buy a house later. What are you going to wait for? A miracle? That rates are just going to go down to 2% again? So let me ask you this. Which is higher, 6.5% interest or 100% interest? Your rent is 100% interest. You're not gaining equity in paying down your mortgage. You're not gaining equity in the appreciation of your home. All that rent is just going towards interest. The right time to buy is when you have a stable income, a stable location, and the payment makes sense for you and your family. So yeah, there's a lot of bad info out there. If you want someone who's actually just going to be straightforward with you, tell you exactly what's going on, explain everything about all your disclosures, all your numbers, feel free to reach out. You can always message me, and my website is on my profile.